Hello and welcome to this episode of the Australian Finance Podcast. My name's Owen Rask. Today, we're going to stretch our minds a little bit. We're going to talk about ETFs, but we're going to talk about the thing that a lot of people get confused about, which is currency hedging. If you've ever bought an ETF that's currency hedged, you'll know that sometimes that decision of do I currency hedge or do I not is a bit of a tricky one, and there doesn't really seem to be many good answers out there. In today's episode, Cameron is going to walk us through the exact specifics of how these quote-unquote currency hedged ETFs work. So we're going to find out how do they work actually, like what does it mean to transfer money to and fro, say like the US dollar? How do I pick one? How much should I have in my portfolio? Is there a tax thing that I need to keep aware of? Cameron walks us through all of that. You know, I do a lot of podcasts across the country, do a lot of podcasts every week on investing, business, finance, you name it. And sometimes I think, wow, I just learnt a lot. Now, if you can hang with us in this episode, you may need to play it back or pause and rewind. You're going to learn a lot about how ETFs actually work and why this thing called currency hedging is actually really important to you, particularly if you invest in places like the USA, like you've got like a NDQ ETF from Betashares, for example. This is a really good way to learn about that thing called currency hedging. So I hope you enjoyed this episode with Cameron Gleeson of Betashares. Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Cameron, welcome to this episode of the podcast.
Oh, and thanks for having me.
Today we're going to be talking about currency hedging, and for disclosure and a disclaimer, it could seem a little bit technical for people, but just saying before, you're probably the man to answer all these questions. So we'll see how we go. If you are listening or watching and you get a bit lost, or you have to rewind, that is perfectly understandable. But this, as hopefully
we can break it down.
Hopefully we can break
really
it down.
Get into the weeds, but also break it down.
Yeah. And hopefully it becomes a source of truth for a lot of people that are thinking about currency hedge, not currency hedge. What does that mean? What's FX got to do with investing? All of that and more, hopefully we can cover. So let's start at the ground floor, which is what is currency hedging?
Currency hedging is when you are investing as an Australian in overseas assets, whether they be shares or bonds, and looking to take out the impacts of the Australian dollar's value relative to the currencies in which those assets are held. So in other words, trying to take currency fluctuations out of the picture and in a sense, and this is somewhat simplified, but trying to give you the same return profile as I would have if I was, say, for example, a US investor holding US assets, but doing that for an Australian investor and seeing those returns in my Australian dollar account reflect really the price movements in that currency, whether that be US dollars or another country.
Okay, so that kind of sounds pretty simple. Like I just want the return of, say, US stocks, and I just want that return. I don't want the currency messing with things in the middle. How does currency impact my returns?
Yeah, so if we think about this as an Australian investor, and let's just say I'm investing in a US fund, so it holds the US equities, the way that we might think about this, and I'll talk I'll use some example figures. If we think about an Australian investor investing in a fund that held, for example, $100 of US dollar assets, and say the exchange rate at this time, and I'm going to invert them here, that $100 US was the FX rate meant that you could buy $150 of Australian dollars with that US dollar $100, then what that means is in Australian dollar terms, my portfolio is currently worth $150 Australian. Now, let's assume that I hold that fund or that investment for a month. And let's assume that in US dollar terms, the price of the shares in that basket don't change. And so in US dollar terms, after a month, I would say that basket would be worth $100 in US dollar terms. However, if the Australian dollar is appreciated then that could erode the value to me as an Australian. So let's just say if the exchange rate has moved from that US dollars being worth 150 to only $140 in US dollar terms, then that currency's really impacted my overall return outcomes. And I'm worse off despite the fact that the US shares haven't really moved in their own currency.
Because we'll talk about this in a sec, because there have been periods, very long periods, in fact, where the currency seems to be going one way or the other, like structurally, maybe not every day, but over months and years. And I remember there was a time when I was buying US shares at the same currency, like 1 for 1, which I thought was, it seems like normal, but as we'll find out, maybe it's not so normal.
That was a great time, wasn't it? When the Australian dollar was at parity a long time ago. Cheaper US holidays. But.
Yes, absolutely. And that's probably an interesting way for people to think about how FX does play into their life, whether they're buying something from Amazon in the US, or if it's going on holidays or sending money overseas to friends or family. FX plays a big role. So then just to clarify, if I have, say I have like an NDQ, so one of the ETFs offered by Betashares, and NDQ is unhedged, I'm exposed to shares and I'm also getting the currency movement, right?
That's right. That's right. And if we think about, recent history, and I'll go back, so over the last 10 years, the Australian dollar has generally been depreciating against the US dollar. And that's been a real tailwind for investors who have held an unhedged exposure to US equities. So for example, NDQ being unhedged has meant that as well as getting great returns from the fact those shares have gone up in US dollar terms, I've also seen the benefit that in the US dollar itself is more valuable versus the Australian over the 10-year period. And so I've won from both of those factors.
Yeah, so the Australian dollar, if you looked at, most people look at it like AUD, USD in Google or wherever they get their currency, it looks like it's slowly coming down over time, which means any of the US investments back then would now be worth more because they get more if they converted it back. Okay. So let's then dive into something that is hedged, HNDQ, right?
HNDQ, yes, that's right.
Yeah. So HNDQ is the same thing from the out, like you look at the box, it's the same thing. The only difference it's really telling us is that it says hedged, like currency hedged. But what does it actually do different?
Yeah. So let's dig deep, and you can obviously reel me back in. But so let's say you had $100 invested in HNDQ, which is, I'll use that same example I started with, and let's say at the start of the month that the exchange rate was that for $100 in US dollar terms, I could buy $150 Australian dollars. If that was the exchange rate. Now, let's assume that the Australian dollar appreciates over the month. I still hold those, shares, and let's say they haven't changed in value. So what I said before is that they were still worth $100 US dollars at the end of the month. What you do with currency hedging is you enter into a derivative contract, which is called a forward, and this is what all currency hedge funds do, where they are selling US dollars 1 month forward. And so what the fund will be looking to do is enter into a contract to sell 100 US dollars and buy approximately 150 Australian dollars. That's the derivative contract they enter into. At the end of the month, let's say that the Australian dollar has appreciated. So the currency hedging in this case has helped you. The underlying shares in Australian dollar terms without the currency hedging are worth less now. They're now worth $140 in Australian dollar terms. But the derivative contract, the hedging, has made a profit, and that profit is $10 in Australian dollar terms. So rather than seeing my assets in Australian dollar terms move from $150 to $140, I've had the offsetting impact of the hedging activity, the $10 profit, offset the loss in Australian dollar terms on the shares. My overall investment stays roughly the same, $150 at the end as it was at the start. And that's what you're seeking to achieve by currency hedging.
So that's why, and so that's all done inside of the ETF.
That's right. Yeah. So investors don't need to worry about that, but that's part of obviously what's offered in a currency hedge fund. And it's, really about delivering the outcome that that investor would expect to see if they held it in US dollar terms.
Yeah. Okay. So that would probably explain why people look at it a little bit. Some of the currency hedged versions of the ETFs are a little bit more expensive.
Yeah, they are a little bit more expensive. We can dig into the details, but there is a bit more involved in the management. And obviously, managing that currency hedging is important. I think we'll unpack some stuff on tax, which is also critical. But pretty minor. You're talking about an extra 3 basis points, so 0.03%, very small extra cost associated with currency hedging in terms of at least our ETFs.
So this is a bit where I wanted to kind of shift gears and think about like, okay, this is all sounding, for some people, this might sound a little bit technical. For others, they're like, this is exactly what I've signed up for because I'm interested in this right now, which is probably a good thing. For the folks that are on the fence, why should they care about this right now?
Look, this year, currencies and FX, as we call it, has been a really important topic. If you're following the news, you're obviously, probably sick to death of hearing about Donald Trump and tariffs, but this has had massive implications for global investors. And currencies have been very volatile. And what that means is that you might have a global investment, global shares that might have actually done quite well this year, but it's entirely possible that the impacts of currency, if I haven't used currency hedging, have entirely wiped out any gains that I may well have made. So currency is really relevant, especially when they're volatile. And if we can sort of unpack some of the impacts of currency in terms of US policy at the moment, the commonly held view, especially prior to Trump's inauguration, is that when a country starts to apply tariffs to imports, their currency appreciates versus the countries where they're importing from. And before inauguration, the US dollar started to appreciate because that's the sort of the standard view. In fact, what's really sort of started to happen in terms of the US dollar is because the US economy itself is going to be so widely impacted from tariffs versus other economies who only export a small amount of goods really to the US as a share of their overall economy. They're not as impacted. They export all over the world. China exports all over the world. Its exports to US as a portion of its GDP are only about 3%. So the main impacts are really going to be felt in the US. And so therefore the US dollar has suffered as a result, and the US dollar has sold off quite substantially. And what we've started to see is, I guess, a debate about US exceptionalism. For years, investors have invested in US assets, including the US share market, and they're now questioning whether or not that's the right move and looking to perhaps deploy money elsewhere. But we've also seen a shift in global investors thinking about currency hedging. Now, if you go back to about 2020, most global investors who, for example, European pension funds and alike who are investing in US, they'd hedge roughly about 50% of their US equity exposure. That was the average, according to some data. Look, we saw some major custodians look at data of basically investors using their platform. So it was about 50% currency hedged. Now, as US interest rates increased, those investors were able to effectively run this carry trade and get extra earnings through holding US assets in a higher rate environment. And currency hedging rates really reduced down to about 20% at the start of this year. And then we started to see questions on US exceptionalism. And this is where the world has really shifted, and global investors are looking to implement more hedging, increasing currency hedging of their US exposure. Because it's very difficult for global investors to, in fact, sell down US assets, sell out of US equities. But the one thing they can do if they want to protect themselves for a potential end or uncertainty in the US or an end of US exceptionalism is to use currency hedging. And this is putting a lot of pressure on the dollar in itself. And so, our view is that structurally the US dollar will depreciate, and that is a good thing for the Australian dollar, but it has massive ramifications if you're an Australian investor. And we think the conversation about currency hedging right now is really relevant.
So in effect, what you're saying is what everyone thought was true about the way currencies should move, but the Trump administration wanting to bring in all these tariffs, 100% of the US is exposed to tariffs.
That's right.
Whereas whatever we send to the US is only a fraction of our entire country.
A small amount of beef and a couple of drugs and some gold, and that's about it. So it's not really impacting us. It's impacting them, very substantially.
Yeah.
And that is what's created this weakness in the US dollar that we're starting to see.
So we see weakness in the US dollar, aka the Australian dollar could appreciate. So trips to the US might get cheaper for us here if we decide to do that. But also for investors in Australia, higher Australian dollar means lower US dollar value.
That's right. That's right. If you don't currency hedge, then appreciating Australian dollar will hurt the value of your offshore assets, particularly because they're dominated typically by US dollar assets.
So there was a question that I had for you, and I think you might have some numbers for this, and it's okay if you don't. We know podcasts aren't the biggest number related things. Like trying to imagine numbers in your head while you're listening is difficult. But if you can, Cameron, do people tend to underestimate the importance of currency hedging?
I think they absolutely do. And I think part of that is that, as I said before, like, the Australian dollar has been depreciating, generally speaking, up to the start of this year for about 15 years. And, the tailwind has been enormous as an investor. Like, you're roughly talking about an extra 71% over the last 10 years if you held US assets from the currency exposure alone if you were unhedged. And we sort of banked that and said, wow, aren't we wonderful? We invested in the right sort of asset class, global equities, and that's done much better than Australian equities. It's only really when things move in the opposite direction that people start to realize that it's not always necessarily going to be the case, that the Australian dollar depreciates. And you look at a period from, for example, 2001 through to 2007, where we saw this massive commodity bull market cycle. China was welcomed into the WTO, a lot of global trade, and currencies like the Australian dollar appreciated massively against the US dollar. And if you held US assets over that period from the start of 2000 to sort of 2007, if I held them as an Australian unhedged, I would have lost a lot of money. Currency hedging would have put me in a very positive position over that period. So currencies can move in both directions, and we mustn't forget the Australian dollar can also appreciate. We've already seen, early signs of a change in sort of the way that currencies are sort of trending, and I think that can continue. We must be aware of the risks there and the potential benefits from using currency hedging.
So just to reiterate what you said then, that was a 7-year period where people who were invested just straight in the US market lost money versus gained money.
That's right. Yeah. Imagine
7 years.
Holding for 7 years and that difference. You've chosen the same market. It was just one simple decision about whether or not to currency hedge, and very significant difference in the outcome.
Yeah, wow. So that does make a lot of sense then. So Australian dollar, I've just brought this up as we were talking a minute ago. It's around about 64 cents.
Mm-hmm.
Is that normal?
Yeah. So look, I mean, the Australian dollar sort of generally trended between sort of, say, 60 on the very lower bound, up to about sort of 75 over the most recent history. Over a longer term period, if we take the entirety of this century, down to as low as 50, up to a high of $1.10 in US dollar terms. So we've been above parity, and that was subsequent to the GFC. So, there is a wide band. What we tend to find is that a lot of investors, including professional investors, will have a level where they think it's appropriate to currency hedge. For a lot of those investors, adding currency hedging or increasing their level of currency hedging when the Australian dollar gets below 60 or around 60, that's often a marker when we see strong inflows, for example, into our currency hedge funds. Mm-hmm. But I think, right now, look, the Australian dollar has maybe lagged some of the other currencies in terms of appreciating the US dollar. It has a lot of potential upside, particularly if we see, for example, and this is only an example, but if we see China looking to stimulate its economy to offset the impact of tariffs, that could result in more imports of our commodities that would be supportive of the Australian dollar. So there are a lot of reasons why the Australia could lead higher. But, I guess the number one driver will be what happens to the US dollar. Traditionally, it's the US dollar that determines the fate of the Australian dollar. If the US dollar weakens, it's most likely the Australian dollar will strengthen over a sort of a longer term period.
So because you're transacting, there's two different sides of the trade, right?
Yeah, that's right.
It's what happens in the US and what happens in Australia.
Yeah.
And that's the way bigger, more influential trading economy and so on and so forth.
Yep. Yeah.
Okay. So there is potential that if we see China want to stimulate, that could help our resources sector, our exports. And that, just for really simplistic terms, would mean that China needs to transact more with Australia and needs more Australian dollars. Is that kind of the gist?
Yeah, that's right. Buying more commodities, and that's likely to result in essentially inflows of capital into Australia, or essentially needing to buy either Australian dollar assets, or basically transact in Australian dollar terms or US dollar terms, which then can be sold for Australian dollars. That's the sort of
okay, because that's kind of the money flow, right?
Yeah.
So that's how people can then understand like the trading between countries and how that impacts. But another thing is like interest rates as well. Doesn't that impact where these things go?
Yeah. So if we look at, for example, exchange rates over the post-COVID period, the US dollar strengthened because it was one of the first non-emerging market countries to start hiking rates. And it's not often that US dollar interest rates over recent periods have been higher than interest rates in Australia, but that led to strength in the US dollar against the Australian dollar and other currencies. And so we've seen now that there are rate cuts that have sort of come through. The difference in our interest rates is smaller than it used to be. We'll see how that pans out over the next year or so. But interest rates can play a real role because obviously as an investor, if I'm prepared to take currency risk, I'll look to invest in a country or in a currency where I can get higher rates of return. Higher interest rates indicate higher rates of return. And so hence we saw a lot of investors globally shift from capital from their own countries into the US, which had higher interest rates and had obviously there's Magnificent Seven and the rest of the US equity market performing very strongly.
Yeah.
So interest rates can dictate capital flows or investor flows, if you like.
So that's a really good point. It's basically following money globally follows where the best interest rates are because it makes sense. I'll put my money in the bank account in New York, please. That makes more sense. So let's go back a step. So if someone thought that the Australian dollar would rise, as in it's 64 now, let's say they had a view that it goes to 80, right? Like that's a pretty massive move. But let's say, for example, over the next 3 or 4 years, would currency hedging make sense, all else being equal?
It would, yeah. It would. It would mean that essentially rather than an erosion, and I won't do the fraction in my head, but 15 over 65 would be the loss, the rough loss as a result of currency. If you held US dollar assets and they didn't change in value in US dollar terms, you're losing a large portion of your wealth as a result of currency impacts. And if you like, the hedging activity will offset that. So that's really, what you're looking for. And look, it doesn't even need to be a move as substantial as that for it to make a meaningful difference.
Yeah, for sure. Because even if it went to 70, that's 6 over 64, nearly 10%.
Yeah.
Just in that one move.
Yeah, that's right.
Yeah. So I think the thing I keep coming back to is people from the last 15 years, if you're listening to this podcast, even if you may have had super or other assets, you wouldn't have noticed that the currency could have gone the other direction. You've only been used to strong US stock market, strong
We have a recency bias, don't we, in a way?
Yeah. Where either of those two things could go south, or it could just be the case that your US shares keep performing well, but your return as an Australian investor keeps getting weaker because you don't realize the currency is going against you. Okay, so when we think about currency hedging, like if we make a choice between ETFs or whatever, who in your mind, when you think about who is making this decision, is it everyone that should be paying attention? Is it particular groups? Like I'm thinking, does time horizon matter? Does other factors come into it?
Yeah, it's a really good question. A time horizon definitely matters. If you just to look across the arc, if you went back from like the late 80s to today, the currency's roughly the same as when it was then. But there were very large swings, and those swings in the currency can tend to last sort of 7 to 10 years. And so time horizon is really critical. The other impact, which we haven't really talked about, is short-term volatility in periods of illiquidity. So, for example, a few of the days around the sell-off around COVID, and currency is also important there, and we can talk about the factors there. But if I have a very long time horizon, like I'm an endowment or I'm maybe a very young investor going to invest for 30 or 40 years, then maybe there's less of a need because I don't think that currencies will move in perpetuity in one direction or another. There will be some mean reversion. But if I have a time horizon, sort of 7 years or less, I've got to be very mindful of those trends. And the example from the early 2000s where a lack of currency hedging would have wiped out any gains. And so when we, at Betashares, we manage multi-asset portfolios, we looked at this question of currency hedging. And those two key factors that we looked at were, what are the impacts in terms of the potential outcomes from being completely unhedged through all the way to fully hedged when I'm looking at sort of longer term returns or 7 or 10 year returns. And we also looked at another really important characteristic in terms of risk, which is, what does currency hedging do to the volatility, the daily volatility of your portfolio? And this is where the Australian dollar is quite interesting, because in the short, sharp sell-offs, for example, just after the Liberation Day, the Australian dollar will often sell off against the US dollar. And so holding unhedged assets actually help you in that very short-term period where it's essentially a sell everything market. And so really when you're thinking about currency hedging, you're trying to trade off these two impacts, the long-term potential major difference in outcomes versus how do I feel about short-term volatility. So what we found was that when we progressively add additional, incrementally small amounts of currency hedging, we don't detrimentally impact the daily volatility significantly, provided we keep the portion of the global equities portfolio that's currency hedged below about 30-35%. So you're not impacting your volatility or those short-term sell-offs dramatically, provided you keep that currency hedging around about a third of that portfolio. But it certainly helps in terms of impacting those examples like the 2000 to 2007, where you see a sort of 7-year drift up in the Australian dollar. So our view was, based on those two competing priorities, having around about a third of your portfolio makes sense from if you call it a strategic asset allocation decision. In other words, not even expressing a view on currencies, we think that around about 35% of your portfolio makes sense to have that hedged. That's the analysis we did, and that's the conclusion we came to. It may be different for different investors, but we thought that that's about the right balance.
So when you say 30%, like say, so when you say 30%, it's not just like 30% of my international investments, or is it, so it's 30% of the whole portfolio? Or?
Yeah, so the way I think about that, if I think about my portfolio like a pie chart, let's exclude defensive assets. I mean, that they might be, say, let's just say you're a growth investor, 30% of your assets might be in defensives. For the equities, if I had a split of, say, and not everyone does this, but if I had a split of $35 in Australian equities, that would obviously be unhedged. And of the $35 in global equities, I might allocate a third of that, 30% of that, to currency hedge funds. Gotcha. So to simplify things, if all I held was NDQ, I'd hold 2/3 NDQ and 1/3 HNDQ.
Okay.
And that's giving me that balance of some currency hedging, as well as having some of the benefits of being unhedged as well. That's the balance. I should say for defensive assets, global bonds in particular, we typically would look to use currency hedging for global bonds.
The whole thing.
Yeah, that's right. And that's because currency is so volatile, it completely overrides the risk return characteristics of the bonds themselves. But in your growth assets, both currency and equity movements are big drivers of return. So that's where it's really important to consider how much is appropriate. Still leaving some unhedged makes sense. But certainly from our point of view, there is merit in that portion being hedged.
Yeah. Okay. So because most people that listen to the show would have like a majority in growth assets or some mixture of that. So obviously you can't hedge Australian shares because they're in Australia. But of those international ones, we're going 1/3. That makes a lot of sense. Okay. So why, if someone's like, this is all too hard, why not just go 100% hedged?
Yeah.
What would you say to that?
Look, I mean, that might well be appropriate, particularly, if, you've got quite a sort of, I guess, quite a short-term time period. But I mean, what I would say is that will potentially increase your volatility in a short, sharp sell-off. We saw that, I think it was around about the 8th of April this year. When you see a real rush for liquidity in global markets, typically people will sell off almost all assets except for gold, and then often just US dollars. So it'll potentially increase the volatility of your portfolio.
Right.
And that is one of the advantages of holding global equities unhedged. And that's that trade-off I talked about. You want to manage your volatility. So in those short, sharp sell-offs, that global equities actually help you a little bit. But if there's a longer term trend in currencies, you don't want that to eat away at your return.
Yeah. So either way, someone has to make a decision.
They do. Yeah.
Yeah. So
it's an active decision no matter what. There's no copping out of it if you like.
Yeah. So you're either unhedged or hedged or a bit of both. And that's the general gist. So because I know when we spoke about this just off air quickly, that a lot of people just go 50-50. But so when you have those two competing priorities, you mentioned the Betashares analysis suggests 30 to 35%. Yeah.
Yeah. So that's right. I mean, look. So I mean, that could be completely up to someone's personal preferences.
Yep.
I mean, don't forget, a lot of people when they look at the value and the performance of an asset, they might often look at it in US dollar terms. What's the S&P 500 in points? And thinking about it in that way, you're naturally thinking about it in a currency hedged way as an Australian investor. And so, that can also play into how you think about investing. There's I won't say there's any wrong or right answer because people's motivations and their objectives and their risk tolerance is different.
Yeah. Yeah, that makes sense. So keeping on the topic of the two ETFs that we've used as examples, HNDQ and NDQ, just as a real simple question, what are the major differences? Are there any major differences? How do you describe that to people?
Yeah, so they hold the same underlying exposure to the NASDAQ 100 stocks, and the currency hedge version, HNDQ, it also uses that hedging activity, which is using derivatives to essentially isolate or essentially offset the impact of currency in terms of the Australian dollar value of those US shares.
Okay.
The fee is an extra 3 basis points for the currency hedge version. That's the same across all of our currency hedged funds. So we've got currency hedge funds of all our major global funds. We've got HGBL, which is a currency hedge version of BGBL, a currency hedge version of QLTY, our quality fund. So they always start with an H, but HQLT. Likewise, even QUS, our equal weight 500 US shares, HQUS. So they're all priced at 3 basis points over and above the unhedged version. They all have exposure to the same underlying basket. They all use derivatives to provide that currency hedging.
So if someone was listening to this and they already have Betashares ETFs in their portfolio, they could review it and be like, what's the doppelganger for this, so to speak? Like, what's the one that has the currency hedging? I could switch some of my portfolio into that.
Yeah. And like we don't always launch the currency hedge fund at the same time as the other, but we often do. We actually launched HQUS in about June last year, and it has outstripped the unhedged fund for inflows since it's been a very popular fund. And in fact, that's been a real trend this year. I talked about global investors like pension funds and institutional investors using currency hedging or increasing currency hedging this year. In Australian ETFs, there's been periods where the flows into currency hedged funds have been far stronger than into the unhedged equivalent. That's been a real trend of what's been happening here in Australia. So clearly, Australians are very, very, many Australians are aware of the risks around currency and are looking to do something about it.
Yeah, fair enough. Okay. Okay, so I've got a couple more questions here for you. And this next question is probably the one that's going to, if you're hanging with this and you're like, okay, I'm into it. This next question might get a little bit technical really quickly, but then we'll pop back out and we'll talk about more performance related stuff. Can you explain, because you did educate me and a few others in the room on this just before, of the tax implications. So we've already covered the costs of currency hedge versions, but the tax implications of using the currency hedged versions.
Right. And we're really peeling back the onion here.
Yeah.
I wasn't sure if we were going to go here. So tax. So bear with me. I described the way a currency hedge fund works previously, which is it holds the underlying US shares, for example, and then it uses derivative contracts. And when the Australian dollar appreciates, what those transactions do, those forwards do, is that at the end of every month, you roll the forwards and that crystallizes a profit or a loss. And if the Australian dollar is appreciating, it'll crystallize a profit.
Yep.
Now, from a tax perspective, if you don't really do anything special in the way you manage that fund, those profits become realized income for the trust, for the fund.
Yep.
And the fund manager at the end of the year, when they produce their tax statement, will have to produce the tax statement. They will have a large amount of revenue, which is then accessible for the fund investor. And that means a large tax bill for the fund investor. That's how currency hedging works, and it has worked for a long period of time until the new tax regime called TOFA, which stands for Taxation of Financial Arrangements. And what that does is it allows you to link the hedging activity to the underlying shares that are held by the fund. And this is all getting really technical. But essentially, those gains that I talked about before, rather than them being income, they get attached to the shares, and they only become taxable when you sell the shares. And they're also taxed on capital account, which, as we all know, on capital account, if you hold over the long term, it means you get a capital gains discount.
Yeah.
So it both defers the tax that the end fund investor gets, but it also means they pay less tax if it's on capital account.
Interesting.
And so in a period when you hold currency hedge funds, the reason you're holding it is because you expect the Australian dollar to appreciate, which means you think that currency hedging is going to make a profit within the fund. That's the exact time when you don't want something like inefficient tax outcomes to hurt you.
Yeah.
TOFA, this TOFA treatment that we talked about, look, it's very complex, but it can have massive implications on your after-tax outcomes in particular years when the Australian dollar does rally. And it's a really important point. It's quite technical. In terms of our core global equity funds, we comply with TOFA for all of those funds. Betashares do. We think that's really important, and it's a real value add in terms of what we do. And we've seen very large support for our currency hedge funds for this very reason alone, just because they are built in the most tax efficient manner that you can.
If someone wanted to check if their fund was TOFA approved, so to speak, do they go in the PDS?
They can look. You can go. Probably the best thing really is to even call the fund manager. One way that you can see it, and this is a bit tricky, but if you had a currency hedge fund that existed back in 2021, that was a year when the Australian dollar did appreciate. There were a lot of funds that saw very large tax consequences as a result of not electing into TOFA. And as a result of those large revenue gains, they had very large distributions.
Like at the end, like June 30th.
June 30, that's right. Massive distributions.
And then it drops the next day.
And it dropped the next day. And you can, obviously go into whether you use CommSec or whoever it might be, you should be able to sort of see that in the price history. It is a tricky area. It's quite complicated. It's really can be very impactful in certain years. So I think just, ask the fund manager. It's one of the really other critical points on this is that TOFA is effective from the year that you elect into it for any underlying shares that you purchase in that year, but not any shares that you have acquired prior to that year. And what we've done is we've set up such that we're TOFA compliant from the launch of some of our core funds. Other fund managers more recently might have caught up and elected into TOFA, but it only actually applies to the portion of their portfolio that they've bought more recently. So there's a lot of nuance here. We do have some insights on the Betashares page if you're interested, or I'm sure we can link you up to that.
Yeah, because this is it's like the ugly side of investing, which is admin, but it's actually really important.
Tax is so important.
Yeah. And so just to summarize this for people that might have just like popped their head above water now, when you invest in a currency hedged version of an ETF, you're effectively buying two things. You get the shares or whatever it is, and you get the forward contracts. And you might hold an investment for 12 months, and the shares are held for 12 months inside the ETF, but the forward contracts are renewed every month.
That's right, yeah.
So every month it would be like you're trading new things. So there's profit or loss on each of those things throughout the year. End of the year, if there's a gain or a loss, traditionally they would be paid out, the gains, and you'd be like, here's the tax bill. But thanks to this change, it's kind of still bundled up inside. It's contained inside the ETF.
That's right. You don't end up with this money leaving the ETF and frankly ending up in the hands of the tax man. It stays in the ETF, and you can obviously compound your wealth. And that's why we all invest in markets, is the compounding power of markets, right? So
okay, so it's so people can probably see why it's really important. Okay, so I've probably only got a couple more questions. I guess I think we've covered everything. Is there anything else that people watching this, whether they're an individual investor, a financial advisor, just someone who wants to learn about this stuff, is there anything else that you can think of off the top of your head that people should really know about currency hedging?
Look, I mean, I think we've covered some, really important points in terms of, the way that currencies can really, impact your investment over a long period of time. I think it's critical that people, don't fall victim to recency bias and assume that, the US dollar will always appreciate. And some of the previous patterns we've seen in terms of the US dollar being more defensive this year, have unwound. There is a lot of policy uncertainty. We've seen a delay in tariffs, but certainly not a resolution. So I do expect, more volatility throughout this year and further forward. And, we don't exactly know what sort of regime we're going to enter into, but, if you don't know, then, do you want to be, as high conviction as to remain entirely unhedged, or alternatively even, entirely hedged? It sort of makes sense to have a bit of a balance there. And I think that the great thing about ETFs, obviously very transparent. They're generally built to be really tax efficient, as we talked about, but they allow you to have that choice and the flexibility to sort of dial up or down currency hedging global equities where you think it is appropriate.
I think that's a great core message of what we're talking about. I think it's like a regret minimization. This is a decision that you are going to have to make if you're listening to this and you plan to invest for 10 years, 5 years, 4 years, 3 years. It's a decision. So what would minimize a lot of that regret?
Yeah.
It has been very good. I've got the chart here. Since 2010, there's been a lot of downwards movements in the currency.
Yep. This year it's moved the other way. So far this year you would be better off being currency hedged.
Now is a very good time to consider it, is what we'll probably say. So if you're new to investing and you're thinking about this, or even if you've been in the system a long time and you're thinking, this is actually a gray area of my knowledge, we'll link to a lot of the resources, because it was actually your resources. And I think you told me this last year about the 30%.
Right.
And you were probably the person that came forward with the most clarity on this. So I really respect that, mate.
Thank you.
Yeah, it definitely gave me the most, because this is a one decision I can find in finance and ETF investing in particular that remains kind of unanswered for almost everyone.
Yeah, I think that's right. Look, there is no one answer for everyone, but if we look at the way that we run the money that we run, or the multi-asset portfolios that we are custodians of, that is our view as to the right mix, for the objective set within sort of that mandate.
Yeah, okay.
But understanding the reasons for why we do it is important, because they might be slightly different for you as an investor.
Yeah, I just think being aware of it is so important. So I really appreciate this, mate. We weren't even sure if we're going to do this episode because we thought maybe it's too technical, but I hope people stuck with us, because it is an important decision that everyone makes regardless. So Cam, really appreciate you taking the time to share that with us.
Always great to be on.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.